Welcome to the Dividend Talk podcast, episode 165. Our experience with high yield dividend stocks. In this episode, we talk about high yield dividend stocks and how they fit into our overall dividend growth strategy. We'll give our opinions on what companies we hold, why we hold them, and what our thoughts are for holding them into the future. We also look at WP Carey and the recent dividend cut, along with answering some questions from the community. See you on the inside. Hey, European DJ. How are you, buddy?
Yeah, this question keeps on entertaining, right, for you?
Yes.
I'm doing really well. It's Friday night again. Always awesome to record another episode with you. I've got a long weekend ahead. It's in Poland. It's now autumn, and mushroom picking season has started, and I love this. So expect me on Sunday morning, maybe 6, 7 a.m. to wander somewhere through the forest trying to pick some mushrooms.
Nice. Well, look at the difference in both of us right now. You're sitting there in a t-shirt, lovely long summer days or autumn days in Poland, and I'm here in a woolly hat because it's freezing over here in Ireland. So it's there's no mushroom picking going on here. It's lots of rain. But next week I'm off to the sunshine, so I'm all good.
Yeah, and I can imagine there are probably neither too many mushrooms where you live, but just generally speaking, I mean, you must be a dividend investor if you like mushroom picking, right? It's for free in the forest. You can eat them, some not. You need to watch out for that, but yeah.
It's the definition of frugal living, isn't it? Pick your own mushrooms.
Exactly. But I must say, you need to understand this Polish culture to enjoy it because it's awesome. But as a Dutch person in the beginning, I was thinking like, what the hell? Why would anyone do this? You kill yourself, right? You might take a poisonous one, but generally speaking here, people know which ones to pick. Yeah, and everyone has a family member that once had an issue with a mushroom in the past. And yeah, those create the stories at the family dinner tables.
Very good. Anyway, let's move on from mushrooms to dividends. And is there anything in the news this week that sparked your interest?
Well, actually, yeah, because I mean, this is not normal anymore. The Dutch lower house, so it's the first, I guess, body of government where the elected politicians are. They accepted a motion to increase the banking and insurance tax. And it also contains a tax on share buybacks, which is equivalent to the 15% tax on dividends. And it's really a measure to support households that are struggling because of the inflation. And they want to do this, for instance, by increasing the minimum wage. It's not fully into law yet because it requires Senate approval. But for me, this is, country gone mad. I mean, I understand that there needs to be solidarity for the people that have difficulties, but and bankers are wankers. Yeah, that's also how I think about it. But and it came by surprise, just quickly putting a motion in there and taxing companies more like that. My issue is here, not that those are banks. They can be, for me, as punished as hard as they want. I don't like them. I don't trust them. The issue here is that it might set a precedence. Yeah, and we saw already this how you say it happening in Italy with the banks as well.
Yeah,
and I think it is kind of populism or populistic to tell to your voters, and because elections are coming up, to say, look, we took the money from those greedy corporates and we'll give it back to you here. But I think it doesn't work like that. Royal Dutch Shell and Unilever left already the Netherlands and went to the UK. Also for tax reasons. And I think what a healthy capitalistic system needs is a reliable government. So if you wanted to do this already, I think you should announce it 2 years up front. You should probably work with the sector as well, because this makes you not trustworthy, and yeah, companies will think twice before investing in the Netherlands.
Yeah, I mean, they'll just come to Ireland, won't they, with our low tax. Like, it makes no sense to stay in a country if you're going to be taxed for like this for no reason, really. And taxing on share buybacks, I don't know if that has ever happened in any country before. That seems crazy.
Well, it could be a benefit to dividend investors. Yeah, because there might be more focus on dividends than if it's anyway not more tax efficient there. But my issue is not so much about tax on buybacks and such. My issue is just about that you have an unreliable government here that is slightly before the elections start to introduce this, and it sounds like a populistic measure here. And I find this really interesting because as a Dutch person, I follow the news, and I always find it interesting how quickly the Dutch government and such are able to judge other countries on what they are doing and what is wrong and what is right. Yeah. But when you look at this, I think they lost their credibility to judge about other countries when it comes to economy and such. It's insane.
They could be playing games here. They could have put this through just before the elections, so it looks like they're trying to do something, and then elections comes and the Senate doesn't approve it. Maybe that's a possible.
Yeah, but come on, we're not talking about a banana republic here.
Yeah, but look, politics and politicians get up to all sorts of stuff just to stay in power. So you don't know. I don't.
It's insane. It's insane. It is an easy scapegoat to go to the to go after the corporates. It's really an easy scapegoat, but it makes no sense in the long run. It will. I'm afraid it will scare good companies away, and yeah, makes it again less attractive for us also, and more difficult as dividend growth investors if those companies start shifting elsewhere, provided meaning if they go to other countries where it might be harder to, for instance, claim back dividends again.
Yeah, it's an interesting one. All right, so I will look. You know the law is over in Holland a lot more than what I do. So it'll be interesting to see how this actually plays out in the long run, and how actually it affects companies like insurance companies that we tout a lot on here. ASR and NN Group come to mind as well. So
yeah, so the share prices were impacted a bit today, but not as much as the banks there.
Okay. Well, I suppose the other bit of news that's out there this week is the dividend. Well, I'd say a stealth dividend cut or reset by WP Carey. It's one of these ones where they are spinning off their office portion, I think, of their portfolio, and with that, then they intend to reset its dividend. What were your initial thoughts, or did you have any thoughts when you seen this?
Well, I avoided WP Carey. We did a dividend stock report on it, which is available at europeandgi.com via the first newsletter if people are interested. And we wrote there that the dividend is questionable. That the dividend safety score for us of 50 and 40 to 60 is questionable, and 20 to 40 is unsafe, simply.
Yeah.
And we had something along the lines of, look, this company is already at the max of their payout ratio. The dividend growth is really slow, and we expect it to be below the rate of inflation. And we could also foresee a dividend cut coming if the interest rates stay so high for the upcoming several years. Well, they brought it a bit forward, but I think why they brought it a bit forward is probably exactly of what we have observed when looking at their data. I mean, what this whole strategy is about, from the when I skimmed through it a little bit, is about finding a path to growth again.
Yeah.
And seemingly the office REITs are the office part of their business is keeping them back. And with resetting the dividend, they will probably create some wiggle room again to do something more with the cash. So yeah, that's my thinking here. And also Christian from Christian Runs from Twitter asks about it, right? What do we think about that? And and whether I said we see the office buildings like a bad bank or something like that, and also Dividend Dairy ask us about the current situation. But yeah, honestly, for me, it makes sense that they do it. If I would own them, I would actually not know if I would necessarily sell them straight away. But I would bet, based on back on the napkin calculation, that this could be like a 25% dividend cut. I believe it was yielding 6 point something. So if that's the case, it will go to 4.6. But then when I think about that, well, okay, then buy Agri Realty Income or something like that, which has a safer dividend profile and more dividend growth capability ahead of it. Take the loss. If you are in a country where you can do tax harvesting, harvest the tax, because it will probably take some time for WP Carey to find growth again. It's not an easy environment at the moment to find attractive properties. So yeah, I mean, I think the management is doing the right thing, but I could still consider it a sell, not because of the dividend cut, but just because of the opportunities elsewhere.
Yeah. I mean, I was not expecting a dividend cut this soon, I have to say. And one of the strong points about WP Carey is their management. Their management team has been pretty spectacular over the last 10, 15 years. And with their dividend history, and they've not made too many bad moves. My first reaction when I read the news is that it was a little bit of a knee jerk. I think it's maybe a bit too soon. I know the office space is beaten up pretty heavily at the moment. And maybe this is a sign of things to come, where companies don't believe the office space can come back to anywhere near the level that they have. But I did feel like that it was a little bit of a knee-jerk reaction, and I need to sit down and actually dig in a little bit deeper to see, is it the right move? Our management panicking a little bit unnecessarily, because the balance sheet was well able for the dividend at these levels. We mentioned that, well, I mentioned that it'd probably be, if it stayed like this for 3-4 years, we might start to see them in trouble. So I think it's a little bit premature on their behalf. But as I said, their management has been their strong point, so maybe they're trying to get out ahead of this. It will be interesting to see how much they've reset that dividend, and will they reset it to a point lower than what they need, so they have this artificial growth, if you get me. So
Yeah.
look, all that has to be taken into account. So it's definitely one that I will sit down over the next 2 or 3 weeks and maybe write about it as well, because it's a big one. I had only bought 20 shares at the start of last month, so I don't know if I'm going to sell or not yet. I have to sit down and dig this, but it is a shock. I know we had them as 50 out of 100. It was questionable. I just was not expecting it so soon. But what it also gives me is a lesson that, yes, I should trust that safety score. I mean, I don't think we've been proved wrong yet, touch wood. I'm sure we'll get one wrong eventually, but at the moment it's been pretty reliable for us.
Yes, true. That's true, because it's based on facts and data, and not so much on emotions. But it's interesting what you say, because you say about the balance sheet and such. But one of the bear cases for me, why I wanted to avoid anyway WP Carey's, because when I looked into them, they have 55% of their debt outstanding maturing in the next 3 years. And those were interest rates in the low 3% to 4%.
Yeah.
They will not get those back.
No, they won't.
So, and if this is office REITs, you know what banks are going to do with the refinancing on that one. So I don't think that means they have necessarily such a strong balance sheet from that point of view, because you can look at the current debt to equity ratios or something like that, but this will balloon quite quickly if they are not able to refinance their debt at attractive rates. So the numbers today could look good, but if you start putting in the forecast, actually, I think that management is just really proactive here. And if you say, because what was the word you used for management? It was not excellent, exemplary or something like that. Yeah, for slow growth for the last decade. I'm challenging you here a little bit. But if that's the case, I don't think it's a knee jerk. If they are really so clever and they look at their debt wall outstanding there and needing to refinance, and then having office space in there, I think they're just doing everything to protect their credit rating and to make sure that they still get favorable debt. I said,
Rates.
yeah,
Yeah. Look, it'll be interesting. Time will tell if management are proactive or if they're being a little bit hasty. But it's definitely one I have to look into the details a little bit further and make up my decision. But I'll make it up pretty quickly, I think, in the next week or two. I haven't had time this week. Was it only yesterday it was announced? Or was it? Yeah, yesterday.
Yeah.
So maybe over the weekend or early next week, I'll sit down and read what they actually have to say. But yeah, I have to say it was a shock. It was a shock to me that it happened so soon, and it might be a sign of other things to come in that market.
Yeah.
Okay, so we do have some other companies that have hiked their dividends, so it's not all doom and gloom in this market. And I think you own most of these, if not all of them. So the first one is Microsoft, which gave its usual double-digit 10% hike to 75 cents quarterly.
Yeah,
Starbucks,
I love this one. I love this one. Because 10% was also what I was expecting, and they've been doing about 10% all the time. I mean, it's simply amazing what they've been hiking over the last years. And I think they pay now 22 billion in dividends.
Crazy, isn't it?
Yeah. So, and the yield is still very low. And
1%.
the payout ratio, the payout ratio is a bit higher. I mean, it's still healthy, but it just tells you like that this company is a cash machine. It's unbelievable what they are able to generate in cash, and they're also still buying back shares, right? I think they don't need to, but they don't know what else to do with the cash. They are buying what is it? ATVI, Activision Blizzard with pocket change.
Yeah,
I believe it got also in the news that it got accepted the merger in the UK, right? Something like that.
I missed that. I didn't see that.
Yeah, but just to share with you, my yield on cost now is 6.2% for Microsoft, which feels good. Yeah, it feels really good.
It's one of your high yielders, though.
High yield on cost. Yeah.
Yeah.
But Satya Nadella is definitely the king of CEOs of this decade. Yeah. What a man.
I mean, you're not going to be too disappointed with the next company, which is Starbucks, which gave a 7.5% dividend hike to 57 cents quarterly. Just looking here, it's saying that over the past 13 years, their compounded annual growth rate for dividends is approximately 20%. It's quite something.
Yes, that's true.
Yeah. Texas Instruments announced only a 5% increase this time, raising their dividends from 124 per share to 130. It's probably in line with what we expected as well in the mid-single digits. American Tower Corporation gave a 3.2% increase for their dividend as well in Q4 of 2023. I think their dividend yield now stands at 3.6%, and the dividend is now 1.62 per quarter.
I find that a really interesting company because you know my opinion about AT&T and 5G.
Yes,
but I think American Tower corporations are the ones that are really earning from it, because how this typically works, I don't know exactly about 5G, but when you thought about 3G and 4G, they just need to find a site where they can install the antenna. Then they do site sharing with other operators. It's a low investment business once they have the agreement with the landowner and everything.
Yeah.
And then you just rent, or what is it, lease it? I don't know what they use for a decade or something like that. So the capex now might be on the high end, but later on there's little maintenance and reinvestment required in those sites. So that makes it really attractive. But I believe 5G requires more proximity. So I can imagine that in a city it's harder to place all the antennas. So I'm not knowledgeable enough about that one yet, but it intrigues me, this company.
Yeah, I think Brad Thomas was bullish on them as well when he mentioned these guys. It makes sense if you're into telecommunications. Why not go with the guys that are on charge of the towers rather than the people that are spending all our money trying to spread 5G across. But look, I don't know. I don't know.
Yeah.
To me, uh, I don't know. I don't know how over the long term is that going to be the technology? It's constantly changing. When are we going to go from 5G to 6G or satellites and so on? So
Yeah,
it's a
that's the
strange one.
risk to it. The risk
Yeah,
is that technology makes their business model obsolete at a certain moment.
yeah.
I
That's
don't
and that
see it so quickly, but it could. Yeah.
that's my worry. Hey, look, we don't know how quick technology changes. Look where we've gone in the
Yeah.
last 5 years with AI, even so. A couple more companies to go. Curring Dr. Pepper, ticker symbol KDP, raised its annual dividend by 7.5% to 86 cents per share. And the insurance company in the UK, Chesnara, ticker symbol CSN.L, has a low 3% increase to their interim dividend, which gives it an 8.36p per share, which marks their 19th year of consecutive increases.
I love it. I love it. For me, this was a week with a lot of salary hikes.
Yeah, a lot of big hikes there from some big companies. I have to say, so it's quite
Yeah,
good.
and Texas Instruments is still interesting, right? I think this 5% is more at their historical bottom of dividend hikes. And when we did the business breakdown a few shows ago about Texas Instruments, we saw that they have heavily capex coming up, which will impact their free cash flow. So I still find it interesting that they are rewarding us with a 5%. I could have even expected a 3 or 4%, given what they will be investing over the next few years. But I guess this 5% gives them still kind of is still a vote of confidence, I think, by management as well, because we're talking here about a management that is typically under promising and over delivering, and also very conservative in its finance. So yeah, good one.
Yep. Okay, so the main topic this week is going to be high yielding company, yield chasers. Let's have a little chat about it. What is your approach to it? What does actually high yield mean to you?
Yeah. So for me, a high yield dividend stock is generally something that yields above 8%, let's say. Why 8%? I don't know. It's a feeling. I feel like 4 or 5% are like decent yielders. 6, 7% is somewhere in no man's land, but 8% for me really means like a high yielder. And I think they fit nice in a portfolio because I think my goal is to have an average yield of, let's say, 3.5% at investment. If I sometimes take an 8% yield, I expect slow growth, maybe 2% per year or something like that, so they have a 10% return. Yeah, that's typically what I expect. From a low yielder, 1.5% or 2%, I have hardly anything of that. Only the companies that grew into that, but I hardly ever buy them like that. I bought L'Oreal one share then a few weeks ago, but they will require a lot of high growth as a result as well to reach the same 10% yield on cost. After that, you can expect them to grow quicker, but I cannot predict L'Oreal the next 20 years of growth. Yeah, and that it will continue to grow so much. Hence, I think high yielders really have a good place in my portfolio, but I prefer to keep them small. So a single position is really for me tier 3 or tier 4. They shouldn't be tier 1 or tier 2, or it must be really a strong company that I have lots of trust in. But usually I watch a little bit out with those companies because usually they have some certain debt profiles or they are struggling a little bit here and there. But that's also why I don't invest in something that yields above 10% generally. There might be a single exception that I did with Enagas the other day when it touched 10%, because typically when our company's 10% yielding, when they get onto my radar, if the share price was declining rapidly over the last half year. We saw this with MPW, Medical Trust,
Yeah,
Medical
yeah,
Properties Trust. Yeah, they were 6% or 7%, and suddenly 10%, 15%. Usually when this happens to me, and I can't give you here scientific proof or historical proof behind this, but what I have experienced when this happens quickly, usually there's something fundamentally wrong in the business, and it usually results into a yield trap. So I'm usually I'm always staying away from such kind of companies because I find them difficult to assess at that moment in time.
Yep.
But yeah, that's a little bit for me my approach to high yield investing. So, but when I invest in it, maybe a few more questions. The first question I ask myself, like, why is this dividend so high? Has it been historically different, and now suddenly? Is there something wrong with the company of why it is so high? And if it is so high, and I think, okay, makes sense. Do I think that they can sustain it? Is their balance sheet properly supporting it? And actually, what's even their dividend policy? Because at least when they declare a growing dividend, I have a little bit more confidence than that they say the typical European, no, it's 50% payout ratio. So that's a little bit my thinking about high yield and how I approach it. How about you?
Yeah, it's interesting you say that when it goes down quite fast, it generally means there's a problem with the business itself, and that's something I would definitely agree with. When something is tanking, like it was hard to ignore MPW at the time. Everybody was talking about it. It becomes like almost on social media, like you feel like you're missing out. But I think they cut the dividend quite fast afterwards. So the market is generally right when something is tanking really fast. I would say, but I would look at high yielders at anything above, say, 7%. I know yours is 8, and there's no hard and fast rule. It's just I think 7% is my threshold as something that I would find as a high yielder. And when I look at my refocused investment strategy that I'd sat down at the start of the year, I was income focused, and I had two buckets. I had dividend growth, and then I had closed end funds. And the closed end funds was my high yielding part of the portfolio, and it's a small part. I think it's roughly like maybe 15-20% max of my portfolio. It's never intended to be my main driver, but it's something I felt that would drive a little bit of extra income that I could reinvest everywhere else. Usually, um, with closed end funds, the share price is generally stable, and you don't expect too much share price appreciation. You don't expect too much dividend growth, even though there is some that will give you that. But you can kind of count on the dividends that you are going to receive. I was shifting towards UK or US versions to UK purely because I can't invest in the US ones anymore. And some of the investment trusts that I invest in give me access to markets that I can't access over here. Some of the popular ones is Murray International, which invests in lots of different real estate and lots of different um, companies in Europe that you can't access as a retail investor. Another one would be NCYF. That's in like income and global and preferred stocks that I can't access. So, as I said, it was a small part of my portfolio. When I was looking at my portfolio, I realized that some other companies crept in there, and not by choice. I just feel that's where the opportunities were. And there's 3 insurance companies and 2 tobacco companies. The rest of them are CEFs. And I think we spoke at length on this show about insurance companies and the opportunity that they present. And I spoke about some tobacco companies, mainly British American tobacco, but I also own all 3 as well. So that's where that kind of fits into my strategy. I think overall they mark around 40% of my portfolio purely based on the 3 insurance companies and the 2 tobacco companies. Take that out, and the CEFs are a small part of my portfolio. Um, I think where I was going with the CEFs, as I said, was just to drive as much income. And then with the tobacco insurance companies, I feel like, you look at NN Group, you look at even Chesnara have a 3%. There's still dividend growth in those companies. It just so happens that they're beaten down at the moment. I think historically, or even in the future, they won't be such high yielding, or I hope they won't be such high yielding companies. And I might get to see some capital appreciation from them as well.
Yeah, because many of those, to your point as well, I've bought recently. So In my case, I've got 6 of those high yield stocks. Like the
Yeah.
first one is Omega Healthcare with ticker symbol OHI. I've got currently a yield on cost of there on it of 10%. And what was really funny, because I own them now like 6 or 7 years, did you know that I received back in dividends alone 55% of what I invested into it? Which is interesting, right? Now,
Yeah.
of course, in that time, you could have had other stocks that maybe doubled their share price, and it would have been a much better return on investment from a capital gain point of view. But the dividends have been really nicely contributing to other stocks that I've been buying. So what I do with those high yield stocks, I don't reinvest them back in those same businesses. I deploy the money elsewhere. But then if you look at legal in general, NN Group and SBUX, those were really acquisitions I did this year. So I also see that I don't really have any capital gains there yet. Actually, SBUX, I'm 10% in the minus there. But yeah, also those were more like value plays for this year. And then Enegas, I own a little bit longer, but it has been just long-term down at the moment. So I own it now for years. Capital gains are -7%. Yield on cost is about 9.9%. And I received back in dividends about 10%. So this is, you could say, to some extent, dead money there. But yeah, the money that I've been getting, I've been redeploying that. And by the way, received back in dividends is 10%. I just doubled my position like few weeks ago. So on the initial position, for which I only received those dividends, I would have had received back in dividends 20%. Yeah, so, but still, it's not a lot. But that's why those positions are also so small. And Chesnara, also 9.5% yielding right now, and I received back in dividends already 23%, and I own it now for 3 years or something like that. And I've got 17% in unrealized gains. So generally, I'm quite satisfied with that return, because in 3 years, it's like 40% return
No.
on a company like Chesnara. When people are interested in Chesnara with ticker symbol CSN and also on the London Stock Exchange, watch out with that one. It's a difficult business to analyze. I spent really lots of time on it. It's a little bit of a, how you say it? It's a stock that I think I understand, but I don't understand it so well as others.
Yeah.
And also, it's a small cap company. So just also be aware about liquidity issues if suddenly something happens with the company.
Yeah. One of the interesting things you said there was that sometimes it seems like dead money. And aside from Omega Healthcare, which you've held for quite a while, and Chesnara, all of them seem to be negative in terms of your unrealized gains, even with your dividend income taken into account. How do you think about that? Is that something
Well,
that
I
bothers
own
you?
them. I own them less than a year.
Yeah.
So for me, it is. I don't care about that at all. So it's true that they are unrealized gain. But what I've noticed in my portfolio is that if you zoom out and you take stocks that I own for 4 or 5 years, they're actually almost all in the plus. I think I have Bayer that is still in the minus, and Danone. Yeah. So what I'm trying to say with that is, like, when you're dollar cost averaging in new positions, most of the time when I buy something, a stock goes down initially. And that's what you see here with NN Group and such. As an example, SBUX, the real estate investment market, we know where it's going at the moment, only down. So that's why you see those capital gains. But I think if we come back to reasonable situation again for insurance companies and real estates, imagine that there will be a rate decrease somewhere of 0.25%. What this would do to the insurance stocks and the real estate investment trust market, if that would happen in the next 2 years, I think those share prices will really lift up and put everything on the green here. So I'm buying income now with this, and I like total return, of course, as well. I don't want to buy only income and everything goes down afterwards, but preliminary, I'm buying income. So I don't really have a big issue with that, Derek, specifically not because those are relatively new positions.
Yeah. Like primarily what you're really saying is, if you hold them long enough, you would probably start to see some of that capital appreciation or
Yes.
total return come into it. But I'm looking at the share prices for, say, some of the tobacco companies
Yeah.
that I own, like Altria and British American Tobacco, and they look like they're back at the share price that they were 7, 8 years ago. So
Yeah.
in terms of when you're looking at it as an investor, you might see that the share price has gone nowhere in that time, but actually your return is your dividend there. So if you bought them at a low,
Yeah.
at 10% back, I don't know, 8 years ago, your return is probably going to be 10% over that time. So
Yeah, and then you haven't even reinvested those dividends yet and accounted for that, right? Because that's where the compounding kicks in. Yes, some people, how I said, don't look at that when they buy high yield stocks. But if I would probably on my Omega Healthcare start putting a chart, I think that the total return would be actually still quite decent for my holding here. By just if I would have reinvested dividends back into the stock, I mean, I would increase my share count by about, on average, 7-8% per year. Yeah, and those would be generating now 10% dividend again. Yeah, so and that's really the snowball.
So then the question is, why would you not just stick to high yielding companies? Why have low yielders altogether?
Yeah, it's an interesting question. I think that if you look at those businesses, they're all a little bit older. As an example, limited room to grow, and I think that's also why they reward shareholders so much. I do believe that NN Group still has quite some room to grow, but I don't think that about legal in general. Omega Healthcare has been under stress for the last 3-4 years because not enough people are dying there that need their last week for the last mile of their life. Yeah, Chesnara as well. It's doing portfolio management, but in a complicated market. Enagas, don't expect a lot of growth there. So I still have hope for CBUS with quite some growth, but they need to get through this phase of the real estate investment market. So I think that's the issue, and I like more companies that can compound on the longer run. So I rather buy Texas Instruments now, let's say a 3% yield, which could grow the dividends, I don't know, on average over the next decade, 8, 9, 10%. And then when they reach also the same level, let's say in 10, 12 years as those high yielders, it will pass them by really quickly and give me more compounding impact later on in the journey. Yeah. So, for instance, we all know that Warren Buffett, at the age of 52, only had 0.3% of the wealth that he currently has. Okay, the guy is turning 100 soon. Yeah, I don't know if I still have 50 years ahead of me, but it does say something, right? That the compounding is really in the end of our lives.
Yeah, that's the answer I was begging you to say. Really, was a little bit about compounding and how that works. I mean, look, with high yielders, it's nice to have instant satisfaction of income. But if you look at the companies we have listed out there, we've listed out utilities, highly regulated, and we don't know what can happen at the dividend at any point. I spoke about tobacco companies. It is a declining market, so they're going to have to branch into new products, maybe new industries even, to see if they can continue giving the returns that they have. And insurance companies as well, which ebbs and flows quite evidently, which we spoke about when we analyzed Munich RE way back in one of our first episodes. So there's lots of risk with these types of companies. You have to be very selective and careful in who you pick. And I mean, you can, of course, have a large part of your portfolio and generate a lot of income, but at some point you have to move into kind of safer pastures and think more long term. I don't think these are companies that you're going to hold for 20 years because we don't know whether they'll be able to sustain 20 years.
But that's why I think it's so important to do this dividend safety analysis, right? Really assess if a company's dividend is safe. I would say from Omega Healthcare, the dividend is actually unsafe. Yeah, but I've decided to just keep it because it's been doing me well and it kept on paying the dividends all the time. But I think that's why it's so important. That's why also these positions, they only make up 9.6% of my entire portfolio. What is interesting though is that the projected annual dividend income contribution from these stocks is almost 21%. Yeah, so that's because it does the heavy lifting for some of the other stocks that pay a low yield. I'm fine with this. I'm fine with this. It really fits in my strategy to keep this relatively small. It's divided across 6 stocks. So if one of those stocks would go entirely to zero, it will have a 4% dividend income impact. Well, and we saw earlier in the show already how much the other dividends were being hiked. So they will look after that if it's needed. And I don't expect that any of these companies goes bust anytime soon.
No. Look, it's an interesting strategy. I know some people out there do follow a pure income, high yield strategy, and it works for some people. There is a book, The Income Factory, that I read. If people are interested in it, honestly, I can summarize it for you, but pretty much he invests mainly in NCYFs, pretty much high yielding companies or trusts. Is that strategy? So lots of people do it. Lots of people can make a decent return on it, but it is definitely not without risking. You have to understand the different types of markets and what can affect them. And I will say that purely because CFs have been hammered over the last 18 months. They're starting to rebound now, but if you bought them 3 years ago, you're probably sitting at a loss right now in terms of lots of dividends were cut, lots of capital depreciation on those. Luckily, it's a small part, and I've only dipped my toes in. And the companies I picked were well renowned, have really solid dividend histories, and I think only one company has dropped really much. Ticker symbol GLO. But other than that, the rest of them have been absolutely fine. So I'm quite happy with it, but it's not an approach that I would definitely transform over to, because the risk is far too high. I think the pool that you have in terms of solid companies, we spoke about Texas Instruments, Starbucks, Microsoft, the pool is a lot bigger in terms of what you can sustainably, I would say, depend on, is a lot better in some of those companies than these. But it's it's definitely an interesting strategy, but diversification is probably key here. And that's what I'd say.
Definitely. Good. I hope that our listeners found this topic interesting. A bit about high yield. We never really speak so much about high yield dividend investment strategies and such. And yeah, I hope that sharing our approach to it and what we own and such is also helping you in making informed decisions, I would say. But let's go then from this topic to our regular section, the listeners' questions. And the first one is from Kay Jansen from Twitter, I believe, or maybe Facebook. So if you are short of cash and an opportunity pops up that ticks all the boxes, would you consider selling part of your portfolio to buy it? And if yes, how do you determine which stock, or would you go for a small share of multiple stocks?
No, I would not sell unless I was planning on selling something anyway. For example, if I'm looking at WPC and I want to sell them now, then yes, but I would not actively go and look at selling something just to buy something. If I don't have the cash, I don't have the cash. I have to let that opportunity pass until I have something. But no, I don't think I would go and sell anything.
Imagine it's 2009. Johnson & Johnson trading today at 160, but then it's 2009 again. So let's say next year such a crash will be trading at 70.
Even so, you don't know what their share price will be in 10 years' time, unless you travel back in time to 2009, and then we'll know. It's a different case. But even think about it in the present moment. If you are sitting in 2009 now, you could not sit there and tell me that Johnson & Johnson is going to trade at 160. You might think it will happen, and there'll be a good reason to think that, but it doesn't justify selling what I have in my portfolio, because what I have in my portfolio, I obviously have for a reason as well. So I don't think I could sell.
I wish I had the courage that Cameron Stewart shared with us on the podcast. So he was with us on the podcast, and then we asked him this question, and I think was it around Facebook or something like that? And he said, like, one time he went to the bank and just said, like, give me lots of money. I need to buy a lot of this stock. So but I don't think I have the courage for it. I would love to go to the bank and tell them, like, give me 50K at a 4% interest rate, because I'm going to buy up all the Johnson & Johnson I can at $70 per share. I don't think just I have the courage because I'm allergic to debt. I'm afraid of debt, and yeah,
Well, just think 12 months back, Meta was probably the play there when they were beaten up so bad. It was an
yeah,
obvious buy. So if you're going to take out 50 grand,
yeah. But for Meta, not for me. But if I would think about, let's say, Microsoft trading at 100, yeah, just to give an example, all else being equal, right? Still having the growth factors and everything.
yeah.
Yeah, then I would love to have the courage to go to the bank and to ask them how much can I legally borrow.
We spoke about you can't borrow conviction, and that is certainly the case. If you're going to take out a loan, you must have
A
100%
conviction.
conviction. Alex F has asked us, at which interest rate levels will the market break?
I have no clue. I have no clue. What do you think?
I don't know. I honestly, I don't pay attention in detail to these things to know.
No, me neither.
There's a lot more clever guys and girls out there that look specifically at this. It looks like share prices are coming back down a little bit. We spoke a couple of weeks ago. There was a couple of big hedges against the market
Yeah.
where it's going to fall down. So maybe it's starting to break, irrespective of market rates. I don't know, but honestly, I don't. We spoke of macros and stuff as well. I don't pay too much attention to these. Lawrence has asked us a question. Well, asked you a question. He's in a similar position to you, where he has moved countries within Europe with different currencies. Do you ever send money back home? Have you considered a scenario where you have to move back home, and how would this impact your portfolio and dividends?
I don't know. Not. I'm really settled here, so I don't see myself going back. So I don't see neither a reason to send money to the Netherlands. But I do. Yeah, I do have some euros in an account just for. That's more when I'm on vacation. Yeah, because all my money is in zloty, so I do have some euros on the account. And now that he asks it, I did it like 5 or 6 years ago.
Yeah.
But that's more like sometimes you are in an area that it's just for me needed to pay with some euros via my bank account and buy something online, that it's easier. But other than that, not. And if I would move back to the Netherlands for whatever reason, because you can't plan your life, actually it would be a benefit, because here I pay 19% dividend tax and there 15% dividend tax. But I think it would be more interesting to live off the dividends in Netherlands than to pay income tax, because that's better here. So
yeah. I remember, well, both my brother and sister have emigrated, and they're gone roughly 10 years each, and they did hold on to their Irish bank account, and they hold some money there, even though they have no intention of coming back. But they do, when they just use it when they visit. It's just nice for them to have euros that they can come back to.
yeah,
So I'd say it's a common thing to do. What I will mention is he also mentioned that he bought 3M sticky tape the other day, and it was not quite as sticky as he expected, and he is now thinking of suing them. Do you want to join him?
sure, let's do it. 3M, no issue. I'm getting rid of my position anyway, so
Yeah, let's do it. Let's sue him. Dividend Yogi has asked us, what do you think about ASML at the current level?
let me quickly check at what level they are. So they are at €555. I think they're around fair value. Generally, I remember that when I did my analysis one time, it was like upper 500, low 600 for fair value. But that means also that most of the growth is priced in. I mean, it was dipping. When was it? Last year in the 400s. That's way more interesting. So if it will go to the low 400, consider me a buyer of at least 1 or 2 shares. But at this moment in time, I don't find them attractive or something like that, neither after the correction.
Okay. Marek has asked us to look at TROAX Group, ticker symbol TROAX. The dividend is around 2%, maybe not the highest one, but stock seems to be seriously undervalued. And I know you did some pre-work on this.
Yeah, and Marek, thank you also for bringing it to my attention, because it was really nice to go to this company, because this is a Swedish company, TROAX Group AB, and they built this kind of machine guarding equipment, warehouse partitioning. So if you are in a big warehouse and you see the steel structures, that's the kind of stuff they build. Property protection. So think about, if you want to lock up goods, you can put that behind kind of steel cages or something like that. So that's the kind of business they have. Really interesting, because I like such businesses. It's really like, I said, something tangible, right? Instead of the typical SaaS business that we see everywhere nowadays. What I also loved is their sales growth. So in 2012, they were still making 71 million, I believe, in sales, and last year it was 284. So in the last decade, they tripled their sales. They had a blip in 2020 where they were already at 168, and they blipped to 163. But that's where I'm also a bit disappointed in the company. So you can imagine during COVID a little blip, but what they also did, they did a heavy dividend cut at the time. I believe they cut their dividend from 5 to 1 or something like that, and they have yet to recover the dividend. And I looked into their dividend policy, and their target is to pay approximately 50% of its net profit in dividends. And yeah, while the dividend has been growing in the last years, but it comes after the COVID cut. And if I look at their top line numbers, I have not been able to really look into the bottom line numbers, but the top line numbers, it suggests that it might not have been actually really needed. But yeah, I need to keep a little bit of room for myself, because I didn't go into the balance sheet and everything from that time, and the earnings. So that's a pity, and that's why I'm shying away from it. But as a business, it looks like a really nice business. I believe it's yielding 1.6%, and I can fully understand why Marek is liking it. And the question now just is like, Marek, do you trust management to pay you a growing dividend in the next crisis? And if not, do you mind if it would cut the dividends? That's the second question. And that's, I think, a fundamental question between, are you a dividend investor versus are you a dividend growth investor?
Yeah. Yeah, certainly that top line growth looks quite impressive. Tripled its sales over the last 10 years. For such a business, I find it hard to see them repeating that over the next 10 years in my mind. But look, as you said, top line looks good, bottom line you haven't looked into. And with their dividend cut, who knows? But interesting business. It's actually good to come across businesses like this, isn't it? Because you forget these type of things exist with all, as you said, with all the SaaS models. So nice one. Dave Masters has asked us about Games Workshop, ticker symbol GAW. Any thoughts on them?
I first of all, I love the business. Every time when I go to their website on investors relationships, you just fall in love with the business. But I never bought them also because of irregular dividends. It's really simple like that. It's a pity, but it's a high growth business from what I remember last time looking into it. Same story as before. If you trust that management will not cut the dividend going forward in the times of stress like we have seen, like COVID, and what I mean like that is when the company is not in the blast zone, because when 2008, 2009, all banks had to cut the dividend because they were in the midst of the blast zone. In COVID, anything that was giving physical business like Disney or something like that had to cut the dividend. But Games Workshop might not have cut the dividend at the time, and when they last did it. So again here, yeah, it doesn't give me hope for an upcoming recession or something like that, or upcoming market crash.
Cool. Michael has asked us a question about ticker symbol PH, Parker Hannifin Corporation. Again, Michael thinks this is a solid company, probably one of the best in the industrial sectors. And have you any thoughts on these guys?
Well, I looked briefly into it, and indeed, it's one of those 5-6 companies in the world that has such a dividend growth track record, and I stumbled across them not too long ago when I was preparing our dashboard as well for the dividend growth compass service. But honestly, I don't know if it's that much overvalued. They have proper growth. Their free cash flow multiple is trading at a 16. The EPS is 24. So if you do it in the mix, it's probably like a 20 multiple. The yield is relatively low, 1.55%, because the payout ratio is also low at around 33%. So if you would double the payout ratio to 60%, you would get a 3% yield. So I don't think generally that it's that much overvalued as a company, specifically also because they are growing nicely. Yeah, that's my thinking about them. It's just a low yielder. Yeah.
Interesting company with such a dividend streak. Was it 67 years growing dividends? I've never heard of this company, and they're in motion and control as well. I thought I would at least have heard them.
They are in slow motion.
Slow motion, yes. looks like an interesting company in terms of what they do, but that's as far as I know. David has asked us, have we ever considered doing a video version of this podcast?
Well, yeah, we did it all in the beginning, right? But because he's also interested in how we look at the annual report. Yeah, because I know sometimes we have it opened here, we're talking through it. And David, you will, if you go to the YouTube and you search for Dividend Talk podcast, then you will find some videos from the past. The issue just is that there was limited appetite for it. Compared to the effort we had to put into it. It took me sometimes 3 hours to edit it, to make sure all screenshots are in there and everything. It's just too much for us. We have other content that we're producing as well, so that's why we shifted actually almost fully to the audio. We have had some period where we put the audio file still in YouTube, right? But also there we saw limited uptake, if I'm correct. So seemingly our format is just best for Spotify and such.
Yeah, I agree. We tried YouTube, but as you said, you don't really get the appetite for it there. It does take a lot of time. Maybe when we're retired, if we retire early, we could have more time and can do that. But it's definitely hard to fit it all in, particularly when we got full-time jobs, other content, podcasts, and family life on top of that. So it seemed the reward to the work effort just wasn't there. Simple as that. Adrian has asked us, besides Buy Me coffees and the subscription and merch, what can we do as a community for you to help you and your podcast become better and keep working in the long term?
Well, I would need to quit my job. You too. It's really a matter of time, Adrian. And we do this as amateurs. We try to improve ourselves a little bit by investing in the right software and such. So we buy these licenses. That's where Buy Me Coffee and such help to pay for our costs. But I think it's just a matter. It's time, and we like our jobs as well. So we continue doing that. So I'm not sure. I need to think a bit about this more. Maybe I'll get back to you, Adrian, with some thoughts later. But I think we're just really happy. I mean, the fact that the community is there and actually even asking those questions is for us always a big motivation to come every weekend online again to produce the podcast. But for me, it is always like that. Private life first, like my wife and my kids. My work second, and then comes the European DGI content and everything that we produce with Dividend Talk.
Yeah, I agree. Exact same order as well. But it's, as you said, it's a hobby. It's something that we have a passion for, that we like doing. And look, it's always nice that when people contribute and help out as well. It does give you that little bit of extra motivation. But I would just say it was never our motivation in the beginning to do that purely for this. So it's thank you for asking, by the way. It's nice to hear these things. Good. So that's the end of the podcast. Thanks again to all the community for your questions. You keep coming with actually interesting companies and tickers, so keep that up. We definitely broaden our knowledge with these types of companies. So thank you, and we will hope to see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.